Seesaw movements and thin trading was the theme within the markets this week, as investors took a step back from the markets and awaited the outcome of the elections due to be held in Greece this weekend. Global markets began the week with a roar of optimism as traders bought into the short-term fix offered by various Eurozone members for Spanish banks in the form of a token €100 billion to save Spain's faltering banks. Nevertheless, this advance was short-lived as bears sought to remind the markets that the meagre amount provided to Spanish banks was not enough to compensate for a prolonged exposure to toxic debt, particularly caused by a collapsing Spanish property market as well as catastrophically high unemployment claims. The heroes of the day, the banks, quickly became the villains, leading global declines. Spain caught a break from the spotlight midweek, and instead traders focused moved to Italian debt and concerns that Italy may walk in the same footsteps of Spain and plead for a bailout to support a similar debt crisis. However, Spain could not hide behind Italy's debt problems for long, as Spanish yields peaked close to the psychological 7% level, following rating agency Fitch forecasting that Spain would miss its budget deficit targets in 2012 and 2013. The US also had an opportunity to contribute to some chaos in the markets by introducing a collection of poor economic data, including worse than expected monthly retail sales as well as weekly unemployment claims. Once again, calls for another round of quantitative easing were voiced, only to be met by silence from US officials. Short-term trading was the approach taken towards the latter period of the week, as any gains arising from news that pro-austerity parties were taking the lead in Greece were quickly crystallised by traders, due to an opaque view of global growth constraining any long-term holds for traders. The final trading day before the Greek elections proved fruitless. It seems now that only bulls are left, albeit probably in their few, as markets built on positive news that the Governor of the Bank of England, Sir Mervyn King, was injecting around £100 billion into the banking system to encourage lending to small businesses. The European Central Bank President Mario Draghi also followed suit with similar remarks this morning, allowing banks to once again lead within the FTSE 100. Next week's economic agenda, however, is likely to provide a rollercoaster ride for investors, as the results of the Greek elections over the weekend will either play havoc or provide a basis of euphoria for investors. Early indications already indicate that pro-austerity parties are in the lead. However, an unexpected victory for anti-austerity party Syriza could eventually lead to Greece's departure from the Eurozone, but could provide investors with a more transparent long-term picture of global growth, albeit a picture which is dressed in financial meltdowns across global banks.